So, Governor Macklem, the floor is yours.
Thank you, Paul, and good morning to everyone who's joining us. The Senior Deputy Governor, Carolyn Rogers, and I are very pleased to be with you this morning to discuss our monetary policy report and our monetary policy decision. The Governing Council has maintained the policy interest rate at 2.25%. We have three key messages. First, after stalling over the past year, economic growth looks to have resumed in Canada. While U.S. trade policy continues to be a headwind, consumers have been resilient and businesses are adapting. Second, inflation in Canada is poised to ease provided global oil prices decline from elevated levels. And third, uncertainty remains high. The conflict in the Middle East has re-escalated in recent days, and trade discussions with the United States remain ongoing. So let me now expand on the outlook, the risks, and the implications for monetary policy. Growth has been dented by the conflict, and global growth has been dented by the conflict in the Middle East. But with oil prices coming partway back down, growth is expected to recover. Equity markets have been buoyant, and credit spreads remain compressed. Canada's GDP growth was flat over the past year as the economy adjusted to new tariffs, elevated uncertainty, and slower population growth. The economy remains in excess supply. The labor market has been soft, with the unemployment rate hovering in a range of 6.5% to 7%. GDP growth in the second quarter is estimated to have picked up to 2.5%. While this rebound from the first quarter largely reflects the unwinding of temporary factors, sources of economic growth appear to be broadening. Recent indicators point to continued solid consumer spending. Housing activity, which has been weak, looks to be stabilizing. Export growth has resumed and is expected to continue to strengthen, albeit along a lower path. Business investment is picking up, boosted in the near term by the oil and gas sector. And although the Canada-US-Mexico agreement is now subject to annual reviews, more businesses report they are finding ways to navigate through this uncertainty. Government spending also contributes to higher economic activity over the projection. Overall, our growth outlook is similar to our April forecast, but the data we've received since April have increased our confidence that the economy is indeed working through this period of global upheaval. Following GDP growth of 0.7% in 2026, the economy is projected to grow by 1.8% in both 2027 and 2028. As the recovery proceeds, economic slack will be gradually absorbed. CPI inflation rose to 3.2% in May, mainly because of the higher gasoline prices linked to the conflict in the Middle East. Excluding gasoline, inflation was 2.2%, and measures of core inflation have remained close to 2%. So far, we're not seeing broad spillovers of energy prices to other goods and services. Near-term inflation expectations are sensitive to changes in gasoline prices, but longer-term inflation expectations remain well anchored. War-related cost pressures are still working their way through some consumer prices, but they're being offset by downward pressure from other prices from continued economic slack. In addition, the recent depreciation of the Canadian dollar will make our exports more competitive, but it also increases the costs of our imports. Inflation is expected to stay elevated in June and then ease gradually in the coming months, returning to the 2% target in early 2027. I do want to underline that this forecast is highly dependent on the path for global oil prices and gasoline prices. It assumes oil prices come down and stabilize between $70 to $75 US per barrel. Since finalizing our forecast on Friday, the futures curve for oil prices has already moved higher. We've been looking through the direct effects of higher oil prices on inflation, but the longer they remain elevated, the bigger the risk they spill over to other goods and services. As we've said before, we will not let higher oil prices become persistent inflation. The two biggest risks to the projection are still the conflict in the Middle East and our trade relationship with the United States. There are also domestic risks to our inflation outlook. As inflation comes down, there's a risk that it gets stuck above the 2% target. If cost increases and their pass-through are larger than expected, or the economy recovers faster than expected, inflationary pressures will increase. On the other hand, there's a risk that the second quarter pickup in growth is not sustained. The recovery in exports could stall, which would likely weigh on business investment and hiring. A weaker economy would mean more downward pressure on inflation. Based on the NPR projection published today, Governing Council judges the current policy rate remains appropriate to sustain the economic recovery and bring inflation back to the 2% target. However, uncertainty is still high. Governing Council will continue to assess the strength of the Canadian economy and the outlook for inflation, and is prepared to adjust monetary policy as needed. The bank is committed to maintaining Canadians' confidence in price stability through this period of global upheaval.